Now friends, we come to transactional net margin method. Now before getting into the ALP computation under transactional net margin method, we are also required to understand certain concepts that we use to compute the arm's length price. So what are these concepts? So first is operating revenue. So guys, under transactional net margin method, we arrive at operating margin, and henceforth we compute the operating revenue first. You must have seen that under profit and loss account, which has been reported, which has been prepared as per the Companies Act and which has been reported with the MCA authorities, that captures entire set of income as also entire set of expenses under profit loss account. But when we are going ahead with the TNMM, we are required to exclude certain non-revenue items from the total sales as also from the total expenditure. What are this? What are illustrative such non-operating items? We'll just discuss. So once when we first we need to arrive at operating revenue. Now operating revenue is basically total revenue. Out of total revenue, we reduce certain non-operating revenue items, which could be like interest income, dividend income, rent income. If leasing is not the main activity of the comparable entity, then this would be also included, that is rent income. Then IT refund, then other extraordinary incomes which may not appear to be directly related with the activities of that comparable entity, and the other incomes which are not relating to the normal operations of the taxpayer. So that then again, so this type of incomes we have to reduce to arrive at the operating revenue. They are just illustrative income. You may have a bigger list also in your once when you see the comparable entity, you may have bigger list as well. So when you need to exclude that portion of income which is not operating in nature, correct? So that is what the gist is. Now similarly, like in operating cost, we are required to remove certain non-operating cost items, that is non-operating items which could be of this types, like for like interest expenses, like bank interest expenses. So somewhere there has been already also controversy to include interest from working capital loan, but I would remain here on a conservative side, that you should not include the interest expenses, be it if you have paid that interest on loan towards purchase of fixed asset or it for any other purpose like working capital loan. So you should always exclude that, because financial charges are not directly related to the operations of the business, is what there's a general TP position, right? Then provision for uncertain liabilities. If there is a bad debt reserve, then the reserve needs to be reduced, not the bad debt which has been written off. Actual, you don't need to reduce that, but the provision for bad debt reserve you need to reduce that. So similar uncertain liabilities provisions, in case if you find that contingent liabilities has been debited under the profit loss account, you are required to exclude that, and you are required to appropriately arrive at an operating cost. Now there are many examples like forex loss on account of loan or interest repayments. So now if interest is excluded, then the forex loss also, when you are making a payment of interest to your to the overseas bank or your overseas entity, then that is also required to be, the forex fluctuation on that particular part also is required to be excluded from the definition of from the when arriving at the operating cost. Also I wanted to tell you one thing here. At times I have also seen that unrealized foreign exchange loss is also being reported under the profit loss account. So at times there have been some positions taken to exclude that particular portion of unrealized forex loss as well from the profit and loss account, and appropriately if you are able to get that data from the profit and loss account, I would recommend you to exclude that also. That's only a recommendation from my end, but it depends on case to case basis. If you are able to get data, exclude that, else you can also have a position to include that. It depends on the nature of transaction as well. Now then loss on sale of assets, right? So this is also some this is not this activity does not happens day in day out of a business. So loss on sale of assets is also regarded as non-operating cost item and appropriately needs to be excluded when you arrive at an operating cost figure. Then interest on income tax, donations or CSR payments, and then income tax paid, then pre-operating expenses and other such items which are not incurred in routine course of business. So you need to exclude that to arrive operating cost. I hope operating revenue and operating cost clarifies. Now what is operating profit? It is simple. It is difference between the operating revenue and operating cost, right? So I'll meet you in the next video where I'm going to explain how do you compute this operating margin, where I'm going to show you live how to compute operating margin from your financials which are available with you of the taxpayer entity as also of the comparable entities, right? I'll be meeting you in the next video. Thank you.